The S&P 500 is close to all-time highs. That sometimes investors forget that the S&P 500 doesn't just go up, but it goes down as well. The question is, when is it going to go down, and is it going to go down? Many indicators are flashing red at the same times. Warren Buffett, one of the biggest investors in the world, is sitting on a pile of 350 billion in cash. Although everything is saying that it will crash, Standard & Poor's index is deciding otherwise and continues to go up. I decided to do a thesis and a study on 8 different indicators that professionals use. So macro indicators, investors indicators, and ratio indicators to see if that crash on the S&P 500 is near. If 2026 would represent the end of passive investing on the S&P 500, now require investors to be way more active in the way they do things. Indicators help to tell us the reward worth the risk of investing in the S&P 500 right now. Many questions are still unanswered, and this is why I'm here today to do that analysis for you. Now let's start to look at the first indicator. That first indicator is just a graph representing the S&P 500 adjusted for inflation. That mean, that line that represents the sum of all the yearly return of the S&P 500 since its creation divided by that amount of years. This shows that the S&P 500 is significantly above the mean return. It's exactly 83% above the long-term average, which is significantly high. Now, if we look at the graph on a logarithmic point of view, we can see, so we still have that 83% increase. Whenever we reach that 83% increase, it was during the dot-com bubble in the 2000s, and we are at similar levels right now. Something also to tell us if the S&P 500 is overvalued is what we call price to earning ratio. So it's basically a metric that investors look at, tells us how much investors will pay for $1 of profit. A valuation measures from JP Morgan, which is a very well-known bank, that right now we are at 22 times the price to earning ratio. And that was in January 30th, 2026. There's a statistical way to look at it. Basically, we did the mean of the price to earning ratio for the past 30 years. This shows to be at 17.1. Standard deviation is how far are we from that 17.1x of PE ratio. In that case, we are above one standard deviation, which sits at 20.4x, and we are currently at 22x. So the question you should ask yourself is, would you pay $22 million for a company that makes $1 million a year? For me, it seems very expensive, especially since we are one standard deviation above the current mean. If you don't know me, my name is Alessandro, 19 years old, and doing a master in finance in the top 10 US schools. I was also trained by the former world number 4 in tennis, which gave me that mentality and a different aspect of seeing finance. When I talk with professionals from Wall Street or all the different biggest financial places in the world, they all have one thing in common. They know what real finance is, they have proper education, and second, they have the discipline and the mentality to apply concepts with no emotions. Follow this account if you really want to think and train like a finance professional. Okay, enough talking. The second ratio. Now we have the Shiller PE ratio, which basically tells us if the market is overvalued or undervalued. So the way it's measured is we take the current price of the stock and we divide it by the average of the 10-year earnings of the company adjusted to inflation. So when we look at the ratio, there's 2 things that caught my eye directly. Is once we are above the 30 level, we had one big crisis and another big crisis. The first one is in 1929, where the market dumped 89% after they reached that level. And the second one was in the 2000s for the dot-com bubble, and the market dropped 49%. Right now, the Shiller PE ratio is at 39.35. Again, does it mean the market is going to crash right now? No, because like we see from the Shiller PE ratio before, the market stayed overvalued for almost 4 years at the end of the 1990s. Before actually crashing. The idea here is to say, would you invest your money in something that's significantly overvalued and where the risk and reward is definitely not worth it? Is it worth to put your money at that point in time, given all the risk that is associated to it? Now, if you look at the standard S&P 500 PE ratio, not the Shiller PE ratio, is what we call a trailing PE ratio because we take the last 12 months of the company earning as a divider, and the numerator is still the current price. That S&P 500 PE ratio is a bit more short-term because it's trailing. It adapts to the last earnings, the last 12 months of a company. Compared to a Shiller PE ratio, it's the mean of the last 10 years of earning adjusted to inflation. That S&P 500 PE ratio is not adjusted to inflation as well. It helps us to tell a little bit on a short-term notice if also the market is overvalued or not. A conservative way of looking at that PE ratio is basically if it sits around 12 to 15. in that case was significantly above at 29.26. Why is it so high? Because we expect earnings to grow. That whole thing about the AI bubble is probably the consequence of that, because companies are investing so much in AI infrastructures that we believe that the growth potential of those companies is going to be significant. So we are willing to pay higher price to earning ratio for that growth. But again, is it actually worth it? When we look at the different levels, you can see that when it was really high, in the 2000 crisis, 2008 crisis, 2020, and now we are above again. This tells us a crisis is going to be happening? No, but it tells us we are not at the right level to currently invest. Now, in the possibility that we invest at those levels, what would be our returns? Because that's an important question. When you invest at a certain level, you have an expected return. We can see that when we invest at a forward PE ratio at a 15 times multiple, the returns are sitting somewhere around the 10%, which is usually what you get on the S&P 500 if you invest passively. But based on what I said earlier, I said that passive investing is probably ending, because when you enter a market regime that is overpricing all the different companies, which is the case of what we're seeing with a forward PE ratio at 22, the returns are significantly harder to get. If we have a price to earning ratio at 22, which is what we saw previously, we can see that the estimated return somewhere below 0% or around 0%. So you're going to be in that area. So again, are you taking the risk of getting between 2% or minus 2% of returns by investing the same amount of money that you did previously when market could potentially return 10% a year? So you're basically taking a huge amount of risk for a low amount of reward. Traders will know that whenever you open a position, your risk to reward needs to be positive. In that case, I'm not sure it's that positive or in your favor. It means that when you invest, you have to be way more active in the way you manage your position. That's number one. And number two, you need to start to do stock picking, which is something that is very difficult, and you need to have really good financial knowledge in order to do that. Just investing in the S&P 500 every month is probably not the best option right now, because your returns could potentially get crushed. And when we look at the S&P 500 again, we can see that if we invested at the top of that 2000 AI bubble, it would have taken us almost 20 years or even more to make that money back. So are you willing to take the risk of potentially waiting 15 to 20 years to get the money you're investing right now? But what do the best investors think about the current market situation? Take a look at one of the biggest investors of all time, Mr. Warren Buffett. So his indicator is very simple. He's basically saying, I'm going to compare the total US market stock value and the annualized GDP. And GDP is the gross domestic product of the economy, so it's the sum of all the goods and services produced within the economy. So something that's actually created a value. Comparing that value of the economy with the value of the stock market. Currently, that value is sitting at 230%. He's basically saying if that value goes over 200%, investors are playing with fire. I pull up this graph where we have the historical line, so the mean, of the US stock market value to GDP. The bigger the standard deviation is, the worse it is, and it means the market is significantly overvalued. Far away from that mean, we're not one standard deviation away, we're two standard deviation away. And we are even going towards 3 standard deviation. Ratio is 75% higher than a long-term trend. So this is basically saying that the US stock market is pricing potential economic value that hasn't been created yet. Which is understandable, because when we look at all the investments in AI, they haven't proven to be worth it so far. Money is going out of companies' pocket to finance those investments, but are they actually bringing money back? So far, we haven't seen any of this. So this could explain why we are 2 standard deviation away from the mean US stock market value to GDP. Our best friend Buffett, what is he doing in those situations? He's accumulating cash because he wants to be liquid. In times of crisis, if you invest your money, your money is stuck in a stock or in an index. Yes, it's probably easy to take it out, but you don't want to lose money. In that case, it's safer to keep your money than to invest it in something that's not worth it. So he's currently keeping 344 billion of cash. Only in 2025. In 2026, his holdings probably increased. So this is not the first time that he does this. In 2021, he was accumulating cash also as well, and he had a short-term investment of 190 billion. The S&P 500 gained 10%, but then the index sank 20% in 2022. And that was because after COVID, we had a huge inflation and the Federal Reserve had to control it. So they raised rates really fast, and this causes the stock market to go down. Because if rates are really high, you can borrow less because it costs more to borrow. And thus, if you borrow less, you have less money to expand your company. And if you have less money to expand your company, the earnings are usually lower, which causes the S&P 500 valuation to go down. Also did something similar in 2005, so 3 years before subprime crisis. He started accumulating 48 billion. And then the market rose 30% in October 2007. So he might have missed on those opportunities. But when there was a major stock crash, he was the one that was able to deploy all that capital in order to make significant returns. If we go back to our previous analysis, 2008, at that peak, it would have taken us until 2015 almost to make that money back. Is it worth to risk your money for 10-15% to potentially have a crash of 40-50%, or keeping your money safe and then deploying it when that 50% crash happens and benefiting from it? If you invest at the wrong time, like so many people did at the end of 2007, you have to wait 8 years to get your money back. So if it's money that you don't need, that shouldn't be a problem. But usually when you invest, you want to get returns, otherwise there's no point. Probably better to wait 6 months to a year and miss on some opportunities, but invest at better levels. Warren Buffett is not just stopping to invest, you see? He invested in 9 stocks and being way more selective in the way he picks that stocks. And that's a whole different thing that you need to do. Once you invest passively on the S&P 500, it's very easy. But when you start to picking stocks and you need to look at them and really look at what they're doing, it's called active investing, because you need to pay attention to their earnings, to what the company does, how much they sell, what's their cost, looking at balance sheet, income statement, cash flows, in order to make a thorough analysis and take the best decision possible. Why passive investing is probably something that is starting to end. Market is starting to be reserved to people that have the knowledge, the ability to analyze stocks that are worth investing in. Letter number 6. I basically compare the historical 10-year Treasury yield with the S&P 500 PE ratio. Basically, when the yield rises, the S&P 500 should get cheaper in order to attract capital. Why? Because from the point of view of investors, once you invest in a bond, it has zero default risk, meaning it's risk-free. Once you invest in it, you're sure that you're going to get your capital back. So this is what happened, for example, in the 1980s when we had a huge rise in the yield, and in that case, we had a fall of the S&P 500. Stocks have to compete with bonds in that case. When you have a bond that pays 16% in return, that is risk-free, why would an investor take the risk of investing in stocks? There's no point. A brief explanation on that. So yields rise usually when the Federal Reserve, increases their interest rates. It means that the discount rate is going to be higher, and when companies discount their future earnings to the present, makes them less valuable in today's dollar, thus causing the S&P 500 PE ratio to go down. But something is happening since 2023. We are seeing the yield rising and the stock valuation rising or staying the same. Usually we saw that there's an inverse correlation, so when one goes up, the other one goes down. It means 2 scenarios can happen. First one is either the Fed cuts aggressively and the yields go back to 0%. This would mean that the Fed has to have a reason to cut aggressively, or the stock valuation goes down. In that case, let's say you have a $100 stock and you get 3.6% return. So you get $3.60 a year. But if that stock price is going to 75%, now you're getting 4.8% return a year. Why? It's because now your return represents a bigger portion of the initial stock price. But this is another indicator that definitely tells us that it's probably not the best time to invest in the market, because that inverse correlation is not respected. Now, what about Damodaran's model? He's a professor at NYU and he basically created a model for valuation. The 2 things we're going to look at is basically the T-bond rate and the earnings yield. The 2 things that I saw is definitely that the earnings yield is somewhere around 3 to 4%, and T-bond rate is between 4 to 6%. This comes back a little bit to what we were just saying. Why would you invest in a stock that is overvalued, that doesn't provide a significant amount of return, when you can invest in something that has similar return or even higher return that is risk-free? This is exactly what Damodaran's model is showing, is the earnings yield is lower than the T-bond rate. And in that case, shifting to bond investment, short-term treasuries, could be an option instead of investing directly in indexes. And lastly, I wanted to show you that indicator. It's inverted yield curve. To explain this very easily, usually the longer time frame that you have when you invest, the more risk you're taking, because more things can happen within that time frame. It means that when you have 10-year treasuries, the yield on those 10-year treasuries is going to be higher than the one on 2-year treasuries, because over 10 years you take more risk than over 2 years. Usually what we do is we compare the yield of the 10-year to the 2-year treasuries. When yields are higher on the 2-year than on the 10-year, it shows that there's an inversion in the yield. And like the graph says, an inverted yield curve has predicted the past 7 recessions. So the one that's the end of the 80s, the 2000, 2008, 2020 almost, and then we had 2022 also right there. Actually, when it reintegrates that the recessions are happening. So we can see it breaks, then it reintegrates, recessions happening. Reintegrates, 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 recessions happening. So again, that thesis, is it a good risk to reward to invest? Is it the right moment to invest in? Yield right now is reintegrating, but we haven't seen a recession yet. We usually say that what happened in the past in the market tends to repeat itself. In that case, we haven't seen a recession yet. But is it something that could happen? Yes. The probabilities are in favor of this happening. So again, would you want to invest your money when the yield curve is reintegrating? I don't think that would be the best option. Brings us to our last case. Is it going to happen in 2026? Is that recession, that minus 20, 30, 40% going to happen in 2026? I pulled up the data from the 1950s all the way to 2023 of the S&P 500 return depending on the presidential cycle. So year 1, 2, 3, and 4. So we can see that on year 2, usually of the presidential cycle, the returns tend to be significantly lower. So we see that on year 1 it's usually 8%. Last year, on first year of Trump's term, we had good returns on the market. Year 3 tends to be good as well. Year 4, similar to year 1. But year 2 is significantly affected at 4.6%. So based on all that analysis, what I wanted to do is potentially hedge myself for the investments I've currently made. Because I've made some investments in the past, so I'm not going to remove all that money that is exposed on the market. I bought at good prices. Even if the market is overvalued, I could potentially take partial profits, but I'm not going to remove my exposition because I already benefited the composed interest over the years. So then I thought, what if I could take a short position on the S&P 500? So there was basically this key level right there that wasn't broken since December of 2025. I put my stop loss just above that key resistance level. The idea to potentially see a 20% downside on the S&P 500, which would hedge the other investments that I have. I also removed a bit of exposition of that money on the market. I still keep some, again, for this composed interest. Our thesis was to show, number 1, is it a good risk to reward to invest? It currently is not. Is it the end of passive investing? Possibly, because when we have indexes that are significantly valued, like the S&P 500 right now, you need to pick stocks properly, and you need to do stock picking, which requires a lot of financial knowledge. And number 3 is, when we look at all the valuation of the S&P 500 of those companies, do I feel comfortable putting my money in a company that I have to pay 22 million that generates $1 million a year? You know, with all the different indicators that I have, or even Warren Buffett keeping such a huge amount of cash. He's one of the most successful investors of all time. So when you have all of those indicators combined and you actually put them together, it looks like a puzzle that tells me that it's not a great time to invest. Or if I invest, I significantly reduce my exposition to smooth my DCA and my long-term curve. Follow if you want more of those analysis and put in the comments all the questions that you have. I'll try to answer all of them. I was Sandro, and that was how to think and train like a finance pro. And as always, good luck on the market, good luck in your investing, and I hope that video was helpful.